Hello, good morning. Hope you're all fine. All right, so Rako here again. In this session, we are going to talk about the central banks and the monetary policy rates. Right. But in the previous session, we spoke about what money is, where we said money is anything that is generally accepted for the payment of goods and services and also for the payment of debt. Right. So we also made mention that money have had some three basic functions, right? Where we said it serve as a medium of exchange, it serve as a unit of account, and also a store of value. We explained those things in the previous video. We also spoke about the evolution of money, and we also spoke about the monetary base, where we spoke about M1, M2, M2 plus, and M3, where we established that Ghana has up to M2, right? We made mention that M1 is also called narrow money, where it comprises of currencies plus travel checks plus demand deposit plus other checkable deposits, right? Where we say M2 is M1 plus any other kind of less liquid deposits or less liquid kind of money, right? Where M2 plus is M2 plus foreign currency deposits, right? So in today's session, we are going to talk about, let me share this. In today's session, we are going to talk about the central banking and then the conduct of monetary policy rates, right? First of all, you ask yourself, who is the central bank or what is the central bank or something like that? The central bank is like the bank that actually performs monetary policies on behalf of the country, right? It's more or less like the bank for all the banks, right? The bank for the government, like the boss of the nation. He makes sure that the country is going in the right direction in terms of monetary policies and the likes, right? So in this video or in this session, we are going to talk about the central bank monetary policies, the tools that are in there, and how they control money supply. Right, so that's what we are going to talk about in this video. Now, it's the central bank's responsibility to make sure that money is not too much in the system and money is not also less in the system. So, what will the Bank of Ghana do to make sure that money is not too much and money is not less in the system? The Bank of Ghana or the central bank have some tools or has some tools which he uses or which they uses to do this kind of um they do to use like this what they use to do this kind of measurements, right? So these tools includes open market operation, reserve requirement, policy rate, reserve requirement, and then discount rate or monetary policy rate, right? So let's check this out. I'm coming. All right, so the central bank uses these tools. right? The central bank uses. So the first one is open market operation. Second one, yeah. Third one is manage reports. Where the so-called discount policy. Right, so let's pick this one by one and then look at how they affect money supply in the system. So first one is open market operation. Now, before you come to open market operation, we should know that the government of Ghana or the central bank can decide to supply more money into the system or reduce money into the system, right? But in any situation, this central bank will look into this kind of environment he or she is located, right? Like the environment the central bank is located. So if the environment, if the central bank finds himself in an environment where citizens like to spend than investing or than producing goods, then what it means is that when government actually increases money supply for that particular kind of region, so in an environment where citizens spend more, what will happen is that when there is an increase in money supply, citizens will have more money. Citizens will have more money, and then they are what going to spend more, and this is going to do what increase inflation as well. But if the government find himself in an environment where citizens instead of spending, they rather don't spend, like they rather don't just buy things or spend, but they what whenever they get money, they use it to build companies and then produce goods. Then what happens here is that in this kind of environment, when money supply increases, when money supply increases, the citizens are not going to do what? They are not going to spend, but they are going to what? Build factories and then produce goods to the system, right? Now, when they produce goods into the system and more goods are now plenty in the system, what do we think will happen? Inflation will reduce, right? So this is what makes the central bank's work so dicey. You have to find yourself in like you have to identify the kind of environment you are in before you apply this kind of rate, or you like increase money supply, right? Sometimes even citizens can be spending, but maybe it might be seasonal, right? They might be spending based on some season, and then some other season they are not going to spend, but they are going to produce goods. So you, the central bank, also have to know all these things, right? So it's not easy. It's not easy to be up there and then be making decisions for the whole country, right? So that's why sometimes when they are bashing the central banks or the uh, minister of finance and stuff, I don't really follow them because it's not easy up there. Even just controlling your household, 'cause look at how difficult it is. More or less like now controlling the whole country, right? So now this is just the downward. So this is just something for like a preamble or basics, right? Let's actually look at what happens when this tools comes in, right? So we made mention that the tools are three: open market operation, reserve requirement, and then monetary policy rate or the discount rate. So we started with what open market operation. I'm trying to explain what we are coming to do in the slides before we go into the slides, right? And then pick up some points where maybe I wasn't able to explain. So open market operation. Right. So open market operation is a situation where government do what? Issue or buy securities from the public. Right. So here, open market operation, government or the central bank issues or sells securities to the public. Right. And also central bank purchases these securities from the public as well. Now, for the central banks issuing or purchasing these securities will depend on what he wants to do. Now, if the government wants to what reduce, if let's say the government wants to reduce money supply, right? What will happen is that since the government wants to reduce money supply, the government will what issue securities. Issue securities. Now, when the government issues securities, what will happen is that we citizens will come and what buy, and then now we will send the money to the government, right? So now citizens will buy, Citizens will buy, and the money will be what? Sent to the government, right? The same way when now, sorry, so this same way, so now when government issues securities, we will buy, then money will go to the government, and then what? Now, money supply will what? Reduce. So this will what? Reduce money supply. So this will reduce money supply. Now, if government wants to what? Increase money in the system, increase supply of money, then what will happen is that now government will what? Purchase this security from us. Now, when the government purchases these securities from us, he's giving us money. So money is coming back into the system. So now he wants to increase the supply of money in the system, right? So when he does that, what will happen is that now more money will come into the system. Now look at it. Now, when government is aiming to reduce inflation, in the beginning, we made mention that, or we established that from the first session, we established that the more money is in the system, people are able to what? Buy more or spend more, right? When we are in more or less like an environment where people spend more, right? People will be spending more or buying more, which will what? Increase inflation. Now, if government wants to reduce inflation, then you what? Issue securities so that we will come and buy, then less money will be in the system. Then inflation will be reduced. And then inflation will reduce. The same way, if government thinks that, oh, inflation is too low, right, or productivity is too low in the economy, what the government will do is that now, when the pages and the more money come into the system, what do you think? Inflation will rise, right? But also note that when more money is in the system now, people that are ready to what? Do business are going to establish company, and then what? The economy will also grow, right? Right. Economy will grow. Now here, when money is being taken out of the system, the economy will what? The economic growth will fall, will reduce. Let me put it that way. You get. So this is the intuition behind this, right? So issue securities, citizens will buy, less money will be in the system. Now this will what? Reduce inflation. Now this is going to do what? Let productivity to also what? Fall because money is not in the system. So productivity is going to fall. Productivity is going to fall. Now, when productivity falls, what do you think will happen? When productivity falls, unemployment rate will what? Will increase. unemployment will what? Will increase. The reason unemployment will increase because now we are not able to produce. There's no businesses available for them to even produce. So this will what let unemployment rate to also increase. People will not be employed, right? So the same thing will come in now when the economy grow, unemployment will what unemployment is going to what fall, right? So now central bank normally wants to what maintain price stability. But price stability too is dicey. Like maintaining this price stability too, the same central bank wants to make sure that the economy will grow. Now, if the central bank wants to maintain price stability, then it means what? He is going to what? Issue shares or issue security. Sorry, issue securities. Now, when he issues securities, less money will be in the system. Now, when less money is in the system, productivity will fall, so economy will not grow, right? Now, if in case he say that, okay, then let me increase more money in the system so that the economy will grow. Now, inflation too will rise. So you see, this job is not easy. But when we are yet near Kaya Chom saying, oh, we were born, ni money and the likes, but with it's not easy. Most of you on paper like this is easy. But when you are there, it's not easy. Now, if you plot this on a normal graph, I like to represent it on the graph because on the graph, it makes a bit sense and easy. So you have something like interest rate here. Interest rate here. And then quantity of money. Now, when it comes to supply of money, it's like this. Right. So it can either shift to the right or to the left based on. So let me put MS here, MS here. Now I'll shift to MS1, money supply 1, or MS2, money supply 2. So MS1 is when what? Money supply has been increased. And we said that money supply will be increased when what? There's what? Issue a purchase of securities. When the central bank purchases securities. Now, here will be as a result of what government issuing securities. So MS2 will be when government is issuing securities. That will what cause a shift to the left, and when what purchases to cause a shift to the right. You get it? So this is how it will look like for the open market operation, right? So when the demand of money is fixed in here like this, and you could see that this is going to depict a different interest rate, whilst the initial one is also going to depict a different interest rate, and then and it goes here like this as well, a different interest rate. Right? You can see here R1, R2, R4. Right. So this is it for the open market operation. And we are going to dive into the next one. So the next one we are having is the reserve requirement. So the reserve requirement is more or less like the amount of a deposit that the central bank will want or will tell the normal banks to actually put down, right? So if let's say someone brings 100 CDs as deposit and the reserve requirement is like 10%, and it means that out of the 100 CD, you have to keep 10 CD and then you can use the rest to do your business. You get it? So the bank should can put 10 CD down and then use the rest to do his or her business, something like that. Right. So now, if the government wants to increase money supply, and this is supply, getting tired, that's why. Increase money supply. Then what it means is that the reserve requirement to what will reduce. So central bank will reduce reserve requirement, RR. So if let's say the reserve requirement is now what 5%, what it means is that the bank can have what 95 CD instead of 90 CDs now to borrow out or to lend out. And this would increase the supply of money in the system. But if the government wants to what decrease money supply, then it's going to do what? Increase reserve requirement. In the sense that if let's say from 10%, it is now up to what 15%. And it means that the bank will now have only 85 CDs to what to take, like to loan out or to use it for business. So there will be less money in the system. Now we good. I'm sure we're good up to this point. If you have any question, you can drop it in the comment section. Now we've spoken about this implication of the more money in the system and less money in the system already. So it also applies in the same way. If in case you still don't understand the reserve requirement, let's assume this is our total money, right? Now let's assume the reserve requirement is 50%. So let's divide this into two. So let's say 50%. It's not possible, but let's 50%. So we divide it into two. What it means is that this side, the shaded side, has been given to the central bank, right? You can't use that one to do your normal business. So what you can use to do your business is this side. What you can loan out is this side, which means what this is what you can loan into the system. But if let's say the reserve requirement is 25%, right? Then it means that what, this is what you are going to give to the central bank. And then this is what you are going to loan out to customers. What do you think will happen? Now, what will happen is that you'll be able to loan more money out. That is the intuition behind this reserve requirement. Now, let's go to the discount rate. Or monetary policy rate. Now, on a normal note, the central bank is the lender of last resort, right? So if banks are to do businesses and like if banks are to transact business, they do it among themselves like normal interbanks. But if let's say they need some money and the interbanks are not able to provide, that's when they fall on the central bank for money. Now, this makes the central bank's rate higher than the interbank rate because if the central bank's rate isn't higher than the interbank rate, then what will happen is that these banks will always come to the central bank for money, and they wouldn't be doing business among themselves, right? So this central bank will also want to what? Increase or reduce money supply, right? So if government or if central bank wants to what? Decrease money supply, money supply, what will happen is that this discount rate will then be increased by the central bank. Because when this rate is high now, banks will not come in then. Will not be it will not be attractive for banks to come to the central bank for money. So it will increase. Now, when this rate increases as well, this rate will be transferred to the interbanks because remember Bank of Ghana on our rate near 23% too, right? And then Miss remember about 20%. So what I say. That's how it was. So when I came to the Bank of Ghana, the rate is 23%. So means I'll give it to you around 20%. But if you are going to loan out, you are going to take something around 28% or something like that from the customers. Now, when this rate is high, first, these banks will actually not be really, it will not be attractive for the normal banks to come to central bank for money. Now, this rate will be transferred to we, the individuals, when we are coming to take loan from these banks, right? So, because of that, we will not be what? It will not be attractive for us to what? Take out loans. So, this will reduce money supply or this will decrease money supply. Do you get it? Now, if the central bank wants to what? Increase money supply, what will happen is that then it will what? Reduce interest rates, reduce the discount rate. Now, when he reduces the discount rate, now coming for money will be what? Attractive because the rate is low. So you what? You what? It will be attractive for you to what? Come for money. Now, otherwise, like in other form as well, if the rate is low, and you have money, you'll be willing to spend instead of what? Investing. Because you know that when you invest or when you put it in an account, the yield will be small. So you wouldn't actually put money in the account, right? The same way when you are going for a loan as well, the interest rate is low, so you'll be what? Taking more loan. And this will increase the supply of money in the system. And then some in an environment where they like productivity, they'll be producing more goods because now more money is in the system. They'll be investing more into their personal business, producing more goods, and then what? For that part, will reduce inflation. But in a situation where they actually spend more than producing, now inflation will start what? Increasing. So this is the intuition behind it. Concerning the first side, when money supply increases, inflation is normally or likely going to increase. And when money supply reduces, inflation is what's likely going to reduce. Right. So on the graph, I'll see something like this. Interest is here. Quantity of money. Right. Now, see, this is the normal, it's not the government wants to do. MS1. Let's say demand for money is also like this, and it will not change. Right. Now, let's assume that government wants what? Increase money supply. So now increasing or shift this money supply claim. Government is the one that normally supplies money. That's why this curve is straight upwards like that. So let's say MS, the customer receive. Now you see government increasing money supply. What are you seeing? Interest rate is what? So, so let me just say R1. Now on a normal this like that is what? R2. Right. So when government increase to this side, the new equilibrium here, so it's R1, and you can see interest rate is low because but the supply of money has what increased. Now let's assume that now government wants what reduce money supply, so it will shift to this side. Now government wanted to reduce money supply. What are you seeing? Interest rate is what? High. Are you seeing it? So decrease money supply, interest rate is high. Reduce money supply, interest rate is what? Low. So you get the whole concept now. I'm sure you get the concept now. Right. So sometimes as well, when government is trying to what reduce interest rate, then you can sometimes the demand will also be reducing. Now, when this is trying to happen, then Charlie economy in bed because you are trying to reduce money supply, so you are reducing interest. You see that now demand will also what reduce. So let's say demand has also reduced like this. So you will see that interest rate has money supply has shifted, but still interest rate is still around here now. It has not moved, right? It has not moved. Even though this one has changed, it has not moved. Interest rates will not change. Now, here as well, interest rates will not change. Here, so interest rates will not be that low. And that's how it happens like so both of them can change simultaneously. But it depends on the situation, and then this is very, very critical when something like this happens. So with this, I'm sure you now understand all the three monetary policy tools and then how they impact on the economy when they are increased, when they are decreased, and the like. So if in case similar thing like this come in our exams, you'll be able to write your heart out, right? So I think with this, we can go onto the slide and then now look at what is there. So this is basically what the slide for today is talking about, but I decided to break them down before we go onto the slide, right? So let's go. So central banking, we've explained. There we should be able to describe the key features and functions of the central bank, summarize how conventional monetary policy tools are implemented, and the advantages and limitations of each tool. And we should be able to explain the key monetary policy tools that are used when conventional policy is no longer effective. Then we should be able to assess the degree of independence of the central bank. That one, the way I really wanted to teach this particular topic well, but this headache is really worrying. This headache is worrying. So I'm not able to teach it. But if in case you don't understand anything, you can hit me in my DM or you can drop it in the comment section. I'll be there to explain. So central banks, modern society cannot function well without central banks because, as we said earlier, we established that they are the people who actually control the money movement in the economy. So central banks are not just important banks well-being, but also the overall well-being of individuals. So they think about all of us. We have also seen the movement. We have also seen that movement in money supply affect interest rates, consequences for inflation, right? So when interest rate is low, inflation is likely going to increase because money supply will increase. When money supply increases, inflation is following. Now, this is the origin of the central bank, where I think you can read. So it traces its roots from the Bank of Gold Coast and the like. So I think you can read this on your own. And the same origin, I think you can also read this as well. And you can use this link to read more about this. Now, this is the composition of the central bank. So it has the governor, who is the chairperson, the first and the second deputy governors appointed under Section 17, one representative of the Ministry of Finance, 9 other directors appointed by the President in consultation with the Council of State, and then D will hold office for 5 years. So the 9 other directors appointed will hold office for 5 years, and then eligible for reappointment only 1 term. Now, there are some issues pertaining whether the central bank should be independent or shouldn't be independent, right? Those who are for the independence are saying that if the central bank is not independent, then political parties they are going to influence what the central bank does, right? But those who are against the independence are also saying that if we leave the central bank to do whatever they like, then they are not going to account for anyone and they are just going to do whatever they like anyhow. You get it? So these are just like this is a serious kind of argument. I don't think you can just hop in and then say this is what or this is how it should be. When you think through, you see that both of them are making sense, right? So the cases for independence continues here, where they are talking about a whole lot of stuff. Political pressure would impact if in case they are not independent. Political pressure will impact whatever they do and the likes. So this is the same thing, like what I just explained. Now, those who are against are also saying that if um they are independent without anyone's um overseeing what they do, then they will be undemocratic to have this monetary policy controlled by an elite group. And then they will lack on accountability because they are not going to account to anyone and the likes and the likes and the likes. Like that's what they do. That's what they were saying. Now, in the absence of everything, there's a law which says that the central bank is independent, right? So this law is saying that except as provided in the constitution, the Bank of Ghana in the performance of its function under this act shall not be subjected to the direction or control of any person or authority. So meaning that when they are doing their tax, they are independent. No one can control them, or no one should control them. Now, these laws further on tells us why they should be what? Independent and stuff, right? So we have the Monetary Policy Committee who actually sets those monetary policy rates, right? So in the US, for example, Chair Powell, who is the powerful, yeah, the market is shaky. Omo, omo adwene ahyehye. So, so how the central bank is still the same, financial independence, this can give some insulation, but intrusion is possible because of appointments, because now there's those committees on the central bank committees, no, they are normally appointed by these political parties, right? So still now there will be something, there will be some intrusion. Now, the functions of the central banks are plenty. There are many, right? Some are they formulate and implement monetary policy aimed at achieving the objective of the Bank of Ghana. They also promote monetary measure, the stabilization of the value of the currency within and outside Ghana. They institute measures which are likely to have a favorable effect on the balance of payments, right? The state of public finance and the general development of the national economy. So they also regulate, supervise, and direct the banking and credit system, ensure the smooth operation of the financial sector. So these are all something that I'm sure everyone knows. Promote, regulate, and supervise payment and settlement systems, issue and redeem the currency notes and coins. They also ensure effective maintenance and management of Ghana's external financial service. They also license and regulate other banks and non-banking, right, institutions. They act as banker and the financial advisor to the government as well. They also promote and maintain relations with international banking and financial institutions and subject to constitution or any other relevant enactment. Implement international monetary agreements to which Ghana is part. So any agreement that Ghana is part, they try to what? Implement those agreements. They do other things that even sometimes the act will bring up a new this thing that they should do and they will do it. So the conduct of monetary policy. So this is where what I did on the board comes in. So summarize how conventional monetary policy tools are implemented, the advantages and limitations of each tool, and explain the key monetary policy tools that are used, right? And I've explained everything already, right? I've explained the monetary policy is the process by which the central bank controls the supply of money, right? What they do to supply money, like the mechanism they do or they use to supply money in the system. It also refers to the combination of measures designed to regulate the value, supply, and cost of money in an economy. So, so the goal of the monetary policy is actually to what? to stabilize price, to increase employment, to also boost economic growth, to increase economic growth, to also have interest rate stability, foreign exchange, market stability, and then financial market stability as well. But these goals actually has a conflict. Remember, I explained here that so now in the process or in a time where we want to what stabilize price or price stability, right? When we want to stabilize price, what it means is that we want to make sure that inflation rate is low. Now, when we want inflation rate to be low, what do we do? What we are going to do is what we increase interest rate. Now, when we increase interest rates, money supply, money supply will what? Fall. Now, when money supply falls, then production, now production will also do what? Production will also what? Fall. Now, when production falls, look at adding S3, S3. Now, when production falls, unemployment will also do what? Will also increase. You get it? So you want to stabilize price, so only price stabilization. Look at what is happening. Only price stabilization. Let's put money supply aside. Production is what? Is falling. Right? Unemployment rate is also rising. You see the harm you be causing to the economy. So that's the same thing that happens to the rest of the district. If you want to also maintain economic growth, then what it means is that you want to supply money into the system. Now, when you want to supply money into the system, you are going to reduce interest rates. And when you reduce interest rates, production will increase, right? But what do you think will happen? Inflation will rise, and that will also cause harm in the system. Even though unemployment rate will fall, inflation will rise. So you have to look into all this, and so they are all dicey. You can't just say you can active like get all of them at once. So it will be like you are sacrificing one for the other. You are sacrificing this for the other. So that's how it works, like that, like that, like that, like that, right? So if you want to also what have a high employment, then it means you have to release money into the system so that they can produce. And then when you do that as well, price will not be stable because inflation will rise. The same way, if you want economic growth, pump money into the system so that they can produce, so that economy will grow, but inflation will rise as well. Now, if you want to you want interest rate to be stable, it means you want to reduce interest rate. Now, when you reduce interest rate as well, money supply will what? Increase. When money supply increases, inflation will set in again. MS Katanya Manibio. Market will overheat. Foreign exchange as well, like what we Ghana just did recently, the intervention to make sure that the Ghana cedi is stable. Now Ghana cedi is a bit stable because they did an intervention. Now, when this happens, people or exporters in the country which is trying to compete with other districts, their goods will be expensive because it's a Ghana cedi, are strong. So our goods will be a bit expensive, relatively expensive. And then which will make like them compete like Bema Tokwana, the competition will be so tough out there. Do you get it? So this Ejuma, any Ejuma ketewa o, it involves a lot, thinking plenty. It involves a lot. So that's the explanations we are having here. So you can get time and then read through and then go through them. So this is the employment. That's what I've explained. You can take time and then go through as well. Economic growth as well, I've explained. You can take time and then go through. Interest rate as well, I've explained. You can take time and then go through. Foreign exchange stability as well, I've explained. You can take time and go through. Then stability in the financial market as well. So financial crisis can interfere with the ability of financial market to channel funds from the surplus spending unit to the deficit spending unit, thereby leading to a sharp contraction in the economic activity. Now, there is the conflict among goals because many of the goals mentioned are consistent with each other. As for example, high employment with economic growth, interest rate stability with financial stability, right? However, when price is stable, it has a conflict with interest rate. That's what I spoke about. That's what I explained. And low unemployment in the short run. Probably in the long run, for example, when the economy is expanding and unemployment is low, both inflation, both inflation and interest rates may start to increase because since unemployment is low, most people have job and they are working and they are getting money, right? So inflation and interest rates will start to increase. Now, if the bank tries to prevent an increase in interest rates, if they prevent it, then it may cause the economy to overheat, then causing what? More inflation, right? Since they are not trying to increase interest rate, then inflation will increase. Now, when inflation increases as well, but if the bank increases interest rate to prevent inflation in the short run, now unemployment will also to increase. So that was what I was explaining down there. That's the same thing here we are talking about, right? So you can get time and then go to. So conflict among goals may that presents central banks with some hard choices. And America say, now, other problems concern this can be the time lag. Time lag in the sense that you see when the monetary policy rate is being implemented, it doesn't start instantly. The time before, the time where it will be like they will enact it and the time that it will start actually working is the time lag. Credit crunch will also mean that when there is less loan, right? Now, even though they can actually get loan, but the loanable funds are less, right? Liquidity trap is also there. Just trying to say that where they have actually reduced interest rates, but still people are not actually trying to take the loans and like a high liquidity of banks, foreign banks, and then financial exclusion, poor banking habits, fiscal policy effects, and the likes. Now, we are saying that should price stability be the primary goal of monetary policy? So far, most countries are actually targeting price stability. So US is trying to make sure that inflation is not higher than 2%. But we are trying to target inflation not to be more than 12% because our inflation target is 10 plus or minus 8. We don't want to fall a -2, sorry. We don't want to fall below 8%, and we don't want to be above 12%. But here we are more than that, right? So the hierarchical versus the dual mandate. The hierarchical is saying that we should put the goal of price stability first. If that one is attained, then we can actually do the other ones, or the other ones will follow. But the dual one is also saying that you should aim to achieve two co-equal objectives, which is price stability and maximum employment. This is very difficult. This one, the dual one, is very, very difficult because if you're trying to maintain price stability, since you're trying to increase interest rates, when you're trying to increase interest rates, less money will be in the system for what? Production. Then employment will still be low. You get it? So it's very, very difficult when it comes to this. Now, price stability as the primary long run goal of the monetary policy. Either type of the mandate is acceptable as long as it operates to make price stability the primary goal, right? So if price stability is the primary goal, then still it makes sense, but not in the short run. Now, these are the conventional monetary policy tools, right? So during the normal times, this is what we use, the open market operation, where I say where the government issues securities or buys securities from the general public or from all of us. Then the policy rate, which is also known as the discount rate and the reserve requirement. I've explained this already, right? And go back and then go and then listen. The same application, the same thing. So here we tend to re-explain the open market operation. Sale of bills or securities intend to reduce money supply in the circulation, and purchase intend to increase money supply, right? So this is the same thing. Policy rate is here as well. The same thing. Policy rate discourages borrowing, decreases when it increases, it discourages borrowing, then therefore what? Reducing the money supply in the system. Now, when it decreases, it what? Encourages borrowing, then increasing what? Money supply in the system. Now, it is a reserve requirement where when it is low, it increases money supply. When it is high, it reduces money supply. Same thing. On the failure of conventional monetary policy tools, then that's when we bring the conventional one. So we bring the other one. So when the economy experiences a full-scale financial crisis, conventional monetary policy tools cannot do the job for two reasons. First, the financial system seizes up to such an extent that it becomes unable to allocate capital to productive uses. And so investment spending and the economic collapse. Second, the negative shock to the economy can lead to zero lower bound problem, right? So now this is where they bring in the liquidity provision. The Federal Reserve implements unprecedented kind of increase in lending. So here they'll be lending plenty. So if economy is not well, sometimes they'll be like, come and take loan for houses, come and take loan to open businesses. So loans that will be for opening businesses will have low interest rates and the likes, right? So that is it. So it is the same thing as here. So the tools for the central bank is the open market operation, discount policy rates, require reserve requirements, interest on reserves, large scale assets, and large scale assets, which is the forward guidance. They are all part. Now, the policy instruments, and Kasankasa, the reserve aggregate, which can be the reserve requirement, and then you also have the extra reserves there as well. Then the interest rate. Then the intermediate targets they normally target the M1 aggregate, monetary aggregate, or M2, and then they also target the interest rate as well. Now, their goal is what? This is always their goal: price stability, high employment, economic growth, like what we know already. Now, this is basically like what I explained up there, right? How they want to increase money, the monetary base, or reduce the monetary base. Is still the same thing, like what we explained up there. So if they want to increase the monetary base, then they want to what? Buy from us, and then so that if in case they want to increase M1, they buy from us and then they pay with cash so that M1 will be plenty, right? Or they like the same thing. Now, this is similar to what I explained with the graphs up there already. Same thing. Now, now we can head to inflation targeting, where I said that in Ghana here, we are targeting, they want the inflation rate to be 10 plus 2 or minus 2. It's an inflation targeting. When you go to US, their target is 2%. Right? So inflation, which we know is a rise in the overall price level, right? They normally destroy or erode savings because now your savings will not be worth anymore, because if inflation comes in, the value of your savings will drop. The value of your savings will drop. And like the government have tried to scourge inflation by adopting conservative and sustainable fiscal and monetary policy. Many central banks, CB is not center bank, center bank. No, this is central bank, I beg, have adopted inflation targeting in recent times. In this framework, the central bank estimates and makes public a projected or target inflation rate and attempt to stay actual inflation towards. So what they mean is that they set a target for inflation, then they actually won't make up their mind to work towards it. So that's the same thing that they are trying to talk about here. So now that's why they then bring in what? Nominal anchor. So what the nominal anchor will mean is that it's a target where they are trying to work towards, right? A target. So here they are saying that it's so as we are saying here, many countries, sorry, my network, many countries began to target inflation more directly these days. And this is some 5 elements of the inflation targeting. So first, they make public announcements of the medium-term inflation target. Then institutional commitment to price stability. So other institutions will commit to it. Information inclusive strategy will come in. Now they will increase transparency through public communication about where they are heading to and where they are now, right? Then now they continue to increase accountability. And this is some of the other advantages of the inflation targeting. It allows for the thing like I said, if you have a target and that's where you are going, then you are working towards it. It allows focus on domestic concentration and enables monetary policy to respond to shocks to the domestic economy. Not dependent on reliable relationship between and then inflation. It's readily understood by the public because you've let them know what you are doing, right? It reduces political pressure from time inconsistent policy making. These are other advantages as well. Puts great stress on making policy transparent, on regular communication, because you're going to continue to tell them what you are planning to do. Now it also increases accountability of the central bank, right? That can be instrumental in building public support and the likes, right? Now, some of the disadvantages is delay in signaling, in the sense that you might not be even able to attain this inflation target early, right? And it is too rigid because you are only focusing towards this inflation targeting. So you are doing whatever you want to go and then attain that particular goal. And then it's also potential for increased output fluctuations because you want to get to that particular inflation rate. So sometimes increased output will be fluctuating, and then it should then low economic growth as well because you are basing your growth on inflation, targeting some you are basing your growth on a particular inflation rate, which was actually hinder your economic growth. Now, this is the same composition of the central bank as well. Yeah, right. The governor, the first and second deputy, the same thing again is here. Same thing. The MPC, Monetary Policy Committee, sets monetary policy rates, but may also use other instruments as well. They are responsible for initiating proposals for the formulation of the monetary policies of the bank, provide statistical data, and advice necessary for the formulation of monetary policy. Now, the central bank's mandate is primary goal of price stability, as we know, and then freedom in choosing any instrument, right? Now, who sets this objective? Right, it's a question for the goals. All right, so I think this is where we end today's lesson. It's a long video. Take time, watch, and then consume. Please make sure you drop any question you are facing in the comment section. And if anything, you can also reach me in DMs as well. Not well as well, so yeah, remind me in your prayers now. Exams is coming. This is the time that I'm not well. All right, see you some other time. Bye. Make sure you like this video and also subscribe to the channel if you are new. Bye.